One of the people I just sat down with is Oaktree's Howard Marks, the famed investor, of course. And I began by asking him whether he was fearful of a market sell-off if we did see a presidential impeachment.
Well, number one, impeachment shouldn't come as a surprise. I think it's a foregone conclusion. And number two, given that, if we assume that the market is intelligent, then it shouldn't have an impact. Because if it's a foregone conclusion today, then when it's voted in a week or two, and it doesn't come as a surprise, if it's in line with expectations, things that happen in line with expectations should not have a profound impact on the level of the market.
But conviction is something that you'd be concerned about?
I'm not concerned about that because I don't think it'll happen. You know, they need 20 Republican votes to convict in the Senate, and they don't have one. And I can't imagine what's going to change. In particular, I think that all the evidence is on the table. So how are you going to change 20 minds?
That said, on the political front, the 2020 election, of course, is only a year or so away, but front of our minds for sure.
Yes.
What's your take on the impact that might have on markets?
Well, you know, market-wise, it all depends on whether we have a president who's considered pro or anti-business. The market took off after Trump's election because he was judged to be pro-market, and he has behaved pro-business. So if he's reelected, people will continue to see him as pro-business. They'll breathe a sigh of relief that he was reelected, and that'll probably be healthy for the market. In this case, it's not preordained like the impeachment. I think that there is uncertainty as to the outcome. If he's not elected, then the question is who is. Bloomberg would be judged as pro-business. And the market would like that. Biden, moderate, probably not a strong reaction. Warren, who certainly comes out as being anti-business, anti-Wall Street, I think that hold your hat.
Lee Cooperman said 25% sell-off in that sense. Does that equate to hold your hat in your mind? Well,
look. A week before Donald Trump's election, there were two things we were sure of. Hillary would win, and if Trump won, the market would collapse. So Donald won, and the market went up. And that tells me we don't know what's going to happen. So I try not to make forecasts, and I tend not to believe forecasts, including my own. But I do think that there would be an adverse reaction to a progressive president.
When we look at your broader industry, there's been a lot of price pressure in traditional long-only asset management with the growth of indexes, also more recently in the broker price wars that we've witnessed. Do you think that kind of price pressure is coming to the credit space, to the private equity space?
A lot depends on how it performs. You know, basically, people switched from active to passive management in equity funds because active wasn't working and it wasn't earning its high fees. That's why the fees have come down. I think we're still in a rational market where things that make money for people will be compensated. Things that don't make money for people will not.
When we consider WeWork as an example of a private market company, private market valuations, do you consider that as broadly actually representing a bubble in private market valuations, or is it more of a special situation?
No, I think it was a special situation because I think that valuation of $47 billion earlier this year was made by one buyer. And if that buyer miscalculated, I don't think that's typical of a broad trend. I think it's very interesting to see that the market, one of the roles of the market is to serve as a vigilante and to reject or downprice when it should. The fact that the public market rejected the private market valuation on WeWork, I think, was a very healthy development. And it shows that the market is value sensitive. That's a plus.
I know it's very hard to predict when the current cycle will end, but do you ever think about how big the fallout will be this time round when it does end? Do you think that the sell-off, when it comes, will be bigger than 08, 09, or?
Well, look, if you've been around 20 years, you may have been around 20 years.
I have not always investing.
You've seen two bubbles, tech and subprime, and 2 crashes. And you may tend to think, as may your viewers, that that's it, bubbles and crashes. But the truth is we have ups and downs. We have bulls and bears. And they're not all as profound as bubbles and crashes. I don't see that we're in a bubble this time, certainly nothing comparable to '07. I don't think we're going to have a market decline comparable. Things are elevated, but not crazily so.
But where we stand today, worth taking a little bit of risk off the table?
Well, it depends on from what, but I mean, look, everybody's made a lot of money. The economic expansion and the bull market are old. Valuations are above average. Prospective returns are low. There's a lot of uncertainty in the world. And it strikes me that one should not have as much risk as one did 3 years ago or 6 years ago. You've made a lot of money, take some off the table. That is not to say it's going down. You know, if I thought it was going down, which I don't know how I would reach that conclusion, I would say sell it all. But I never say that, and it's impossible to say that. But I think there are reasons to have less risk going forward than you have had in recent years.
So taking a little bit less risk today perhaps than in recent years, though all things considered relative to the last 3 or 4 investor letters he sent out, I actually thought he was a little more constructive than perhaps he could have been. His comments on WeWork perhaps an indication of that, which I thought also was pretty interesting.